Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is going. This video is going to focus on the S&P 500. I'm going to cover the ASX 200 and gold in a separate video, and I'll leave a link for that in the description section below. I'm also going to tell you about a key development and in an important market, so make sure you stick around for that. As always, this is general commentary and doesn't take your personal situation into account. With all of that said, let's get into our first chart. So here we go. We've got the S&P 500 on the screen, and it really has been a fascinating few days in the market. So on Thursday, we had the CPI release, and the move we had to the upside, it happens to be the 15th biggest up day since the 1950s. So it really was an extraordinary move. And the catalyst of this historic up day was, of course, the CPI coming in better than expected. So let's go over to the 4-hourly chart and start our analysis there. And what's been interesting over the last couple of weeks is that the market really has just been consolidating in a sideways range beneath this resistance band around about that 3,900 mark. So we just compress this a little bit, and you can see the significance of this band, how the market's responded to it over the last few months. So what often happens when a market trades sideways is that it builds up energy for its next move. And you can see by Thursday's price action that it really did build up a lot of energy. And if you've been following these videos for a little while, you'll know that I've been saying that the market just hasn't seemed like it was set up for a crash. And I think the price action we've seen on Thursday, how the market reacted to what was really only a mildly encouraging CPI number, the way it reacted with such strength, I think it really just shows how many people have been positioned for the worst. And when the worst doesn't happen, it can often lead to a powerful move in the opposite direction. And that's very much what we've seen over the last day. Now, just going back to the daily chart, and I think the overall technical picture for the S&P 500 continues to improve. So on the plus side, we've got the price staying a nudge above this resistance band around that 3,900 mark. And we're also now above the 50 and the 100-day moving averages, which is also a plus. So I think we can say that over the last month at least, the path of least resistance has been to the upside, and that very much remains the case. But I think it needs to be pointed out that if this were part of a larger recovery, it's still only very early days. It's the fact of the matter is we still have an established downtrend, and we can't lose sight of that. It's yes, there's some encouraging signs, but this officially remains a bear market. So I think there's a need for treading carefully and not looking at one day and going, well, there's a new trend in place. And I also want to point out that I'd actually be a little bit hesitant to add into my index exposure at current levels. And I think the time to have started to easing into a position, as we've been talking about over the last few weeks, it was after the last CPI where we got that failed breakout and the key reversal day. This was a point where I was saying in the videos that I thought it was worth having some exposure to the market, putting a toe in the water, so to speak. And I've still got the position which I established down around here in somewhere around mid-October, I think it was. And because I've had no reason to exit it, so I'm still holding it, and I'll continue to do so. But in terms of adding to that position, I don't like the risk-reward perspective so much right here and now. Like I look at this, look where the market currently is positioned. It's only about 3.5% to 4% below this down trend line. So that potentially limits upside at least in the near term. And then I look over at the Dow, which is an interesting one, which we spoke about last week. when I look at the Dow, it's rallied close to 16%, maybe 17% over the last 6 weeks. So that's a big run in a relatively short space of time. So I don't think entering up here is an asymmetric entry point. I think the near-term pullback risk is greater than the near-term upside potential. And just looking at these Fibonacci's I've put on, just put on the Fibonacci's of that last rally. If the market were to pull back from these levels, this is sort of the band I'd be looking at for a potential pullback, and also looking at where the moving averages are. When you get a market that goes from below its moving averages and it flips to being above its moving averages, you'll often get a return move and a retest to those averages before trend re-engages and continues upwards, if that's in fact what it does. So I think there are some reasons to be cautious adding index exposure up here, at least in indexes like the Dow, the S&P. I'll quickly show you an area of interest in the market which I would consider putting on exposure now, and it's in the small caps. Been looking at the Russell. Russell's really been performing in an interesting way. Risk reward looks better. So it's just bounced off support. So we've had this move up from the October low, got through this little resistance band, pulled back to resistance, and now it's rebounding off it. So I think the recovery potential in the near term is possibly greater in something like the Russell. And I think the risk is quite well defined, because you could have a stop loss just below these lows just from last week. So it's a relatively close stop loss. Upside potential, you look at this resistance band around 2,100 odd. So it's more upside than downside. If I was going to add to my market exposure through US indices, the Russell is the one which I would be looking at the moment. Now, if you're getting some value from this, please hit that like button, and please leave a short comment. Just, hey, thanks for the video. It just tells YouTube that people are watching, people are engaging. When people do that, YouTube shows more people. And that's why I make these videos, so I can get my message out there, talk about the possibilities, help people understand what could be happening. And if you can do that for me, it'd be amazing. Thank you. And also, please hit that subscribe button if you haven't already done so. I'd love to have you as a subscriber to my YouTube channel. So let me show you another reason why I'm a little bit hesitant to adding exposure to the big caps like the in the S&P and the Dow. So I'm looking at this. I'm looking at the number of stocks which are trading above their 20-day moving average. So it's interesting when you look at this. We're now at an elevated point. We're up around this 90% mark. And when the number of stocks above their 20-day moving averages gets around 90%, tends to be a point where the market pauses and pulls back. Sometimes it leads to large pullbacks. This is not what I'm looking for at the moment. Other times it leads to pauses and consolidations. So take this point, for instance. This was more of a pause and a consolidation. Maybe we're heading towards something like that, but it just does mean there is, I think, the adding up here so close to a trend line when you have this many stocks above their 20-day moving average, just a little bit hesitant, and I'd think twice before adding to exposure. But that said, I'm not looking at pulling exposure off. I think if you've got exposure, I'd be keeping it. I'm keeping my exposure. And I'm going to just quickly show you two more positive developments, which makes me think that, look, maybe there is. When I look at the S&P and I look at the Dow, I think there really is the potential that there could be a larger basing pattern in the makings. But saying that could still take several months to play out. Markets backing and filling, moving sideways. It's bottoming processes, large bottoming processes take time. They don't happen in one day. So looking at a couple of other positive developments, going over to the bond market. So this is a US 10-year bond yield. I spoke about this a couple of weeks ago, spoke about some divergence that was playing out on the weekly chart, and talked about the potential maybe this was we were reaching at least some sort of an interim high. So far that's playing out. We had a strong move lower in yield on Thursday after the CPI, just throwing on some Fibonacci retracements of that last up leg, just gives you some idea of what could happen. What could happen should the bond yield continue to retrace? Potentially start getting levels back towards the mid threes. Now that would be positive for the stock market, I would think, because a lot of the stock market volatility this year has coincided with the increase in yields. So if we see yields start to pull back, maybe that's going to be a tailwind for equities. Maybe that helps equities form a more substantial base. Need to keep an eye on this. Keep seeing how this plays out. Also going over and looking at the US dollar index, which is another interesting part of this broader puzzle. Been keeping a close eye on this flagging pattern over the last few weeks. The risk with a flagging pattern will often turn and break to the upside. This one hasn't done so. The momentum stalled, and we did get the hint that this momentum could have been stalling over the last week or two. Now we're broken to the downside below this lower trend line. So I think that suggests to me that we now have an interim top in place in the US dollar. Price is now below the 100-day moving average. So I think there's potential for the dollar to continue pulling back, bond yields to continue pulling back. So I think that is positive for the stock market. All of that said, I don't think that this is an all-in, go in and buy moment. I think it's a case of holding what you have. I think we want to see how this momentum continues to play out, but there's still a number of scenarios that could play out over the next 12 months, and they aren't all this market's going off to a new high bullish. But I think for the moment, that's where the broader momentum is. Maybe over the next couple of months, we look for some sort of a pause, but then we maybe look for a retest of this trend line. Let's see how it plays out. It's some really interesting things happening, but it's all a case of continuing to monitor that price action on a really regular basis. So hope that was helpful. Thank you for joining me, and look forward to coming back and talking to you next week. Until then, bye for now.